Hello, welcome to the Fin Know-how lesson on organizational forms. The form of a business can be thought of as the scaffolding that the business puts around itself. The attributes of the scaffolding within which the entity's activities are organized is called its form. Just as the scaffolding may be light or heavy depending on the type of construction happening within it, the form of business can also be light or heavy. Our discussion today is about the various types of scaffolding or form that the business can choose for itself. Choosing the right business form is a foundational decision with significant legal, financial, and operational implications. So we will explore various business forms, the key characteristics, advantages, disadvantages, and the factors that influence which form might be optimal for a given business. Let's begin by understanding why the form of a business matters so much. Like I said a minute ago, the form matters a lot because it has financial, operational, and legal implications. So we will review the attributes that attributes of the organizational form that create these implications. The first of these is liability protection. Protecting personal assets of the owners from business debt and lawsuits and other liabilities is a primary concern for business owners and equity investors. This is especially a serious concern for passive investors. Passive investors in a company, as you know, are not actively involved in the business. And so they're particularly keen not to want the liabilities of the business to become their personal liabilities. The feature of an organizational form that addresses this concern is called limited liability. If a particular form offers a limited liability feature, it limits the equity holder's exposure to things that may happen to the business. And it limits it to just the investment that was made by the equity holder and nothing more. For instance, if I make a $10,000 investment in a company and let's say the company's product get hit with a consumer lawsuit that bankrupts the company, the maximum I can lose is the $10,000 that I invested in the company. Now, some forms of organization offer this attribute, others do not, and we will dive into that a little more in a few minutes. The next attribute of organization forms that I would like to discuss is tax. With respect to taxation, different forms of business organization have different treatments under the IRS rules. Certain forms broadly referred to as pass-through entities. So if an organization adopts those forms, those entities are called pass-through entities. They're called pass-through entities because they are not taxed at the entity level. Taxation only occurs when the business distributes profits to the equity holder. And when that distribution happens, the equity holders pay taxes, not the business. The form of organization that offers pass-through taxation, or the various forms, multiple forms offer pass-through taxation, but those are the forms that are typically preferred by small and medium-sized businesses because one of the advantages of a pass-through entity is that it makes tax filing simple. Certain other types of organization face what's called double taxation. They're taxed twice. The entity is taxed when it generates profits, and then the owners are taxed again when the business pays out some of that profits to the equity holders. So there's taxation at the organization level, and there's taxation at the individual owner level. Yet another consideration in terms of selecting an organizational form is the complexity and cost. Complexity and cost not only of the setup, but the complexity and cost of ongoing management of the business. As with most business decisions, complexity and cost are important considerations with choosing the organizational form. Among the various types of organizational forms, at one end of the spectrum are what's called sole proprietorship. They're the simplest and least expensive to organize and manage. But as the businesses grow, their operations become more complex. They need multiple investors to come in. They have more risk, which requires protection. Then they start moving along the spectrum to a more complex form, such as LLC and what's called a limited liability company or LLC. And they get even bigger. They might choose what's called a C Corp or the more corporate form of organization. What they're doing in moving from one form to the other is finding the right trade-off between considerations such as complexity, liability protection, taxation, and so on. Looking at some of the other factors that come into play, especially as the firm grows, the raising of capital becomes an important consideration. For businesses that need to raise significant capital, especially through equity financing, certain corporate forms, especially what is called the C corporation, becomes appealing. It becomes appealing because it allows for the issuance of stock to a large number of investors. This is in contrast to other corporate forms such as LLCs, which have a restriction on how many owners they can have. So from a capital raising standpoint, it makes sense for companies, especially more mature companies, the ones who are trying to access the public markets. It makes sense for them to adopt a more complex form, such as the C corporation form of organization. The choice of business form also evolves as the business grows in its life cycle. A solo entrepreneur might find a sole proprietorship perfectly adequate and attractive even in the early stages. But as the business grows and starts to face greater liabilities or has other considerations that come into play, operational considerations, for instance, it may become necessary to adopt a more complex form, such as an LLC. And finally, the consideration that is often not discussed but implicit in all of these choices is the consideration of business continuity. Some forms, such as the corporate form, offer perpetual existence regardless of ownership change, whereas others, like sole proprietorship, terminate upon the withdrawal or death of an owner. And continuity is an important consideration because it affects long-term planning and stability of the business. And it's hard to make significant investment in a business, for instance, when the entity may cease to exist at any point. This also comes into play when businesses get ready for being sold. A retiring proprietor may have greater difficulty selling the business as a sole proprietorship than he or she would face if the entity was, say, an LLC. To recap, the main considerations in picking an organizational form for a business are limited liability, taxation, complexity, and the cost of setup and ongoing management, the ability to raise capital, the size and stage of the business in its life cycle, and business continuity. Before we move on to the next part of our discussion, I'm going to take a few minutes to come back to the concept of limited liability. because it is important from an entity standpoint for sure, but it's also important from a policy standpoint. Like I noted previously, limited liability is an attractive aspect of an organizational form. To give you a sense of how attractive or how important it is, I quote a, a, a comment by Nicholas Butler, a long-term president of Columbia. I believe he was president of Columbia for almost 43 years. In a speech to the New York Chamber of Commerce in 1911, he said the following: I weigh my words when I say that, in my judgment, the limited liability corporation is the greatest single discovery of modern times. Even steam and electricity are far less important than the limited liability corporation, and they would be reduced to comparative impotence without it. Strong words, huh? Even if this is somewhat of an exaggeration, suffice it to say that the limited liability is an important aspect of modern business structures. So now let's expand our prior discussion, starting with the idea of shielding personal assets. Like we noted before, in a business form without limited liability, forms like sole proprietorship or general partnership, the personal assets of the entrepreneur are at risk for business debts and liabilities. Limited liability is what allows legal separation between personal assets and business obligations, protecting the entrepreneur's personal wealth if the business incurs debt or faces lawsuits. Limited liability clearly matters for investors, but it also matters from a policy perspective because it creates a significant incentive, or the lack of limited liability creates a significant disincentive for individuals to start businesses. And so, if you limit the business liability, it encourages individuals to take calculated risks inherent in starting and growing a business. Knowing that their personal financial futures are not entirely tied to the success and failure of a venture makes entrepreneurship less daunting. In turn, people are more likely to invest time, effort, and capital in innovative ideas, knowing that their potential downside is capped at their business investment. Another attribute associated with limited liability that I want to discuss is the attracting of investments and of investors. Limited liability is crucial for attracting external investments to grow the business. Investors are generally, as you can imagine, more willing to provide capital to business when their liability is limited to their investments, especially when the venture is complex or risky. But another way, imagine how different the investment landscape would look for tech startups if there was no limited liability protection for investors. The improved ability to attract capital has a snowballing effect on the economy too. The ability to attract investment fuels growth and scalability in the economy. With more capital, companies can invest in R&D, expand operations, hire more employees, and contribute more to economic output. And finally, one of the significant benefits of limited liability is that it makes it easier to transfer ownership without disrupting operations. Limited liability underpins the value and tradability of these shares, and without it, along with the transfer of ownership, could be a transfer of the business's liabilities too, making it a much more risky and involved exercise. Okay. Now that we have discussed all of the factors that ought to be considered when making the choice of a form, we are going to spend a little bit of time exploring the different types of business forms that are available to a business. We'll start with the simplest form called the sole proprietorship. The sole proprietorship is the simplest form and easy to set up with minimal paperwork and low cost. The owner has direct control over the business and makes all the business decisions. Like we noted earlier, sole proprietorships are pass-through entities. So it has the advantage of only avoiding taxation at the entity level and and the owner has to pay taxes from the business profits only as personal income. The downside, though, is that the owner is liable for all of the business's debts and obligations. So the owner faces unlimited liabilities. Next, we're going to take a look at another form of business organization called partnerships. There are multiple types of partnerships, and we'll go over the three most commonly observed types. The first is general partnership. In a general partnership, two or more individuals share profits and losses. General partnerships are relatively easy to establish, but because there are multiple parties involved, they require a partnership agreement. Additionally, each partner is individually liable for all of the business debts, even if it's caused by another partner. The second form of partnership that I would like to discuss is a limited partnership. A limited partnership form of organization is composed of two types of partners. General partners who manage business and bear unlimited liability, and limited partners who contribute capital and are not involved in day-to-day management. And the limited partners have the benefit of limited liability. This form is useful for ventures where some investors want the returns from their investment but do not want to be involved with management responsibilities. A third form of partnerships is what's called a limited liability partnerships. LLPs are another variant of partnerships where the partners have limited liability and are not responsible for another partner's negligence or misconduct. You will see licensed professionals such as law firms and accounting firms adopt this form. So that brings us to a, a form that is becoming very popular. You may have seen a lot of companies use this form, and that form is called LLC or limited liability company. The limited liability company adopts a hybrid form, hybrid between the simpler forms such as partnerships or sole proprietorships, the more complex forms such as a C corporation. And you will see in a minute how it is a hybrid form. Now, LLCs have, most importantly, limited liability protection. The owners in a liability in an LLC, by the way, are called members, and so the members' personal assets are protected in an LLC. A big advantage of LLCs is that it has a lot of flexibility in the form of taxation. It can choose to be taxed as a sole proprietorship, partnership, or even a corporation. The IRS rules allow for such flexibility. In terms of setting up and management, the complexity of an LLC is more than that of a sole proprietorship, but less complex than of a full corporation, such as a C corporation. And one of the reasons why you see most startups use the LLC form is because it gives a perception and you could say a reality of a organizational structure that is more established than a sole proprietorship, established in the sense of being able to engage with investors, being able to plan for the long term, for growth, and so on. For this reason, the LLC has become increasingly popular for small to medium sized businesses because you get the benefits of liability of a corporation with less complexity and more flexible tax options. This brings us to the C corporation, the most complex of the forms. Uh, it is a very powerful structure. C corporations are considered to be separate legal entities, distinct from their owners. And C corporations also have limited liability, so the shareholders are not personally liable for debts. One of the big advantages of a C corporation is that it allows for many stockholders, and so it's much easier for C corporations to raise funds from retail investors through stock issuance. And then finally, it has the feature of perpetual existence, which means that the C corporation can continue to operate even if the ownership changes significantly. The downside, though, is that they face the challenge of double taxation. Profits are taxed at the corporate level, and again, when the profits are distributed to shareholders as dividends. Let's now compare this form with another variant of a corporation called an S corporation. And the term S and C, by the way, refers to particular sections of the IRS tax code. The S corporation is different from a C corporation in the sense that it avoids double taxation. So it's a pass-through entity. It does offer limited liability. The downside here is that compared to a C corporation is that the S corporation has to meet specific shareholder criteria. For instance, an S corp cannot have more than 100 shareholders, meaning for all practical purposes, it cannot go public, meaning it cannot go through an IPO to tap the retail investor market because that would mean having more than 100 shareholders. And that limits its ability to raise capital from new investors. Other shareholder restrictions that an S corp faces includes the requirement that the shareholders must be individuals, with a few exceptions, and they must be US citizens or residents. So in summary, S corporations retain the limited liability benefits of a C corp while avoiding double taxation. However, they must meet specific eligibility requirements. And finally, I'm going to turn to a newer form of corporations, one that has been getting some attention lately. It's called the Public Benefit Corporation, or the PBC. What makes PBCs different is that they have a legally mandated social and environmental purpose alongside its profit goals. What this means is that they must consider impacts beyond just that of the shareholders. The impacts for the shareholders, I should say. As such, they also have high standards of reporting on social and environmental performance. And one of the big benefits of our PBC is that they can attract value-driven customers and employees. We have now reviewed the various attributes of the different organizational forms. And what I've tried to do in the next slide is summarize all of that for you for your convenience. So as you can see, you have sole proprietorships, which have the benefit of unlimited, which has the downside of unlimited liability, benefit of pass-through taxation, simple setup with low costs, but again, limited ability to raise capital. Partnerships also have limited liability and pass-through taxation, a little more complex since there are many partners who can come into the partnership, there is the ability to share risk and management. Then so that would be for the general partnership. Then you have limited liability partnerships. Also, pass-through entities, but with the added advantage of limited liability. This form is popular among professional service firms. And then there is a limited partnership where the liability is mixed, unlimited liabilities for GPs and limited liability for LPs. The complexity is moderate to high, but with a better ability to raise capital. Then comes the hybrid of LLC, which has flexibility in its taxation options. It has limited liability and a moderate level of setup and administrative requirements. The C corporations are the most complex of the lot, but one of the big advantages it has is its ability is that the firm lends itself to capital raising through stock. It also has limited liability, but faces the downside of double taxation. S corporations are similar to C corporations in terms of limited liability and complexity of setup, but the downsides are it has significant shareholder restrictions, and at the same time, though, it has the benefit of pass-through taxation as well. So public benefit corporations are a more recent variant that tries to balance profit and purpose. And there are not many public benefit corporations, but especially in areas such as climate tech, they are increasingly popular. Now that we have seen the various types of entities, it is worth looking at what forms are most common. Okay. So if on the left-hand side of the screen, you can see the count or the percentage of the forms adopted by businesses if you use just the count as a metric, meaning that how many businesses are in the US are sole proprietorships, how many businesses are corporations, and so on. And what you see is the vast majority, nearly 72%, are sole proprietorship if you count the businesses by numbers. This is not entirely surprising because in sheer numbers, again, not in dollar terms, the vast majority of businesses are small businesses. And what you also see is that corporations make up about 18%, LLCs about 7%, and so on. Now, interestingly, the picture gets completely inverted when you look at the data, taking into account the scale of operations, that is in terms of dollars. As you can see, reflecting the sheer size and scale of large corporations, the corporate form accounts for 82% of all of the revenues generated by business. Sole proprietorship, which we saw was significant in numbers, account for less than 4% of all revenue generated in the business. Clearly, very interesting data. Now that we have some familiarity in the type of forms, I would like to turn our attention to certain real-world topics. Specifically, I want to take a look at the form chosen by investment firms like VC or PE firms. VCs and PE firms typically adopt a limited partnership form of organization. In this structure, we have what's called the general partner, the GP. It is the entity who employs the people that manage the funds and make investment decisions. As you may remember from our earlier discussion, in a limited partnership, the GP itself has unlimited liability. Not the LPs, but the GPs. The GPs have unlimited liability. So this means that the GP entity is liable for all of the debts and obligations of the fund, meaning it's the general partner's assets could be at risk if the fund incurs losses. However, to manage the risk of these unlimited liabilities, the individuals who form the GP typically set up an LLC to become the GP. And through that, limit the liability to the individuals who sponsor the firm. The other parties involved in a limited partnership are the limited partners. These are the investors who provide capital and don't manage the funds and have little direct control over individual investment decisions. But by becoming limited partners, they gain the benefit of limited liability. Within the structure, GPs earn a management fee and benefit from what's called a carried interest, which is nothing but a stake in the investments of the fund. And by having a carried interest, the GP's interest is now more aligned with that of the LPs. So this is the form that VCs and PEs typically adopt. Why is that the case? Why do investment firms prefer limited partnerships? For one, the fact that the LPs have limited liability encourages large capital commitment. So if you are a pension fund or a sovereign fund who wants to make an investment in a VC, they can do so with limited liability. Secondly, the pass-through nature of limited partnerships helps avoid double taxation. Further, the LP agreements allow flexible role and decision-making definitions. So for instance, this allows the founders to have control over the day-to-day management and operational decisions of the VC fund, the sourcing, evaluating, and investment decisions regarding portfolio companies. They have control over defining the investment fund strategy, overseeing the performance of portfolio companies, and guiding value creation initiatives, and managing the fund process and so on. So the LP form allows the GPs to set up the governance in a way that gives them a lot of flexibility over how the business is managed. So with that, I have covered all of the content I wanted to go over in this lesson. But before I wrap up, I wanted to see how this all of what we've discussed typically or manifests itself in the real world using Google as an example. Now, the parent company of Google is Alphabet Inc. So Alphabet Inc. is the parent company which holds under it Google and several other subsidiaries. It was created in 2015 as part of a corporate restructuring to separate Google's core businesses like search, ads, YouTube, and Android from its experimental ventures like Waymo or Verily or Google X. Now, Alphabet uses a holding company structure where each business unit operates as a separate legal entity under the Alphabet umbrella. This structure allows for greater transparency, accountability, and strategic flexibility. And that's why Alphabet has chosen that form. So to take a closer look at why Alphabet itself is a C corporation, the choice is driven by multiple considerations. Liability protection is a key consideration. As a C corp, Alphabet has limited liability, provides limited liabilities to shareholders. This means that, like we have discussed before, the investors are not personally liable for the company's debts or obligations. The second is capital raising. C corporations, as you know, can issue multiple classes of stock and access a range of investors, and thereby raising capital, having the ability to raise capital from the public markets. Alphabet is publicly traded on NASDAQ and benefits from the structure to attract institutional and retail investors. And as C corporations, and as a C corporation, Alphabet continues to exist regardless of changes in ownership or management, which is ideal for a large global enterprise such as Alphabet. On the downside, since Alphabet is a C corporation, it faces double taxation. It's taxed at the corporate level, and shareholders are taxed again on dividends. However, Alphabet's scale and profitability make this trade-off acceptable relative to the benefits of public ownership and capital access. What's interesting here, though, is that Google, the cash-generating engine of Alphabet, is structured as a subsidiary in the form of an LLC. As an LLC, it has limited liability, it has pass-through taxation, it has operational simplicity, and since Alphabet is the only owner of Google, it has a single owner. So what does this structure do for Alphabet and Google? From a liability standpoint, Alphabet's shareholders are protected. And because Google itself is an LLC, Alphabet is protected from the risks associated with Google's operations. Alphabet faces double taxation, but Google has a lot of flexibility in terms of how it's taxed. And as you can imagine, super important because Google generates a ton of cash. The ownership of Alphabet is in the hands of public shareholders, whereas in the case of Google, the sole owner is Alphabet Inc. Alphabet is in a great position to issue public stock to raise the capital it needs, but Google LLC does not raise capital independently and relies on Alphabet for access to funds. Alphabet is managed by an independent board of directors, whereas Google is managed by Alphabet-appointed executives. From a regulatory standpoint, the burden on Alphabet Inc. as a C corporation is high. It has to file, in addition to regular tax forms, it has got SEC filings and many other regulatory compliance needs under, say, Sarbanes-Oxley and so on. Google, on the other hand, has less of the regulatory burden, and because most of the reporting is internal in nature. And so this is what Alphabet's organizational chart looks like. You have Alphabet, the C corporation, the holding company under which are a series of subsidiaries, Google LLC being the most important. They have other businesses like Waymo, Verily, Google X, and DeepMind, which are all independent or separately organized as LLCs like Google is. Hopefully you found this discussion interesting. We'll wrap up with the lesson at this point, but like always, if any part of this discussion was unclear to you, please feel free to reach out. Looking forward to seeing you at the next lesson. Thank you for your time.